Welcome back. Now, when it comes to real estate, most buyers focus on the price of a home or how tight the inventory is. But one of the most important aspects of your purchase is, of course, securing a mortgage that will work for you in the long term.
Recently, I sat down with Darius Solomon. He's an associate broker at Prudential Douglas Elliman to learn more about that and whether troubles in what's called the subprime loan market will affect the average home buyer. Welcome back, Darius. We're going to be talking about two things that people are so focused on when they're buying a house: the interest rate and, of course, the price of the house. As well they should be. But it's really interesting because what happens is people get so focused on the interest rate that sometimes they don't look at the larger picture.
Too concerned about balancing these two parts together. Most important, like I've always said, is to look at your budget. Don't keep holding out for a specific rate or a specific price. Look at your monthly budget and take that into account, and eventually you're just going to have to make a decision.
Let's take a look right now at where the classic rates are right now, and so people just have a point of reference here. The 30-year fixed mortgage rate at this point stands at 6.25. The 5-year adjustable rate mortgage is 5.75. The 7-year arm is at 5.875, and the 10-year arm is at 6%. Now, as we said, Darius, people are watching this hour by hour when you're looking in the market for buying a house, but where are these rates historically?
Well, historically, if we look, last time we spoke about this in May of 2006, we were looking at rates on the 30-year fixed about 6.875. So historically, over time, off of the boom years of the real estate where we saw very low rates in the 4s and the 5s, it's been a very slow coming up, and they have remained fairly stable for a time now.
Well, you have an interesting comparison that shows just how, when we focus on price, you can see the difference and how different interest rates affect your monthly payment. And you're saying you really should look at that monthly payment. So let's look at a comparison and talk about it. So this is the rate if you get a 6% loan, and here you see the purchase price of this property is $1,250,000. You're taking out $937,500, and your monthly payment there, $5,620. But Darius, let's look at what happens if you go up just 1 percentage point to 7% and see what happens. You have a purchase price here of, say, $1,156,250. You're taking out less money here, $867,187, but what's happening with your monthly payments?
Well, look, you're $100,000 lower in price, and if you look at the monthly payment, it's actually higher than if you had taken it at the higher price.
How can that be?
Well, and that's where people need to really look at the purchase price, at the numbers out there. It doesn't necessarily mean holding out over time for that next bump in the interest rate is going to make a difference. Use your monthly budget, and that's what I stress. It's just like looking at the stock market. Second you buy a stock, you can't start looking at it every hour because it's not the way that you're purchasing. You're not on the stock floor. This is a long-term investment.
And you have to understand, too, that it's hard. There's people who work for investment banks who can't accurately predict where interest rates are going. It's hard for you as just a home searcher to do that.
Exactly. There are people paid millions of dollars to do this, and and even at that point, nobody knows what's going to happen with the rate tomorrow. So take that into account.
Darius, there's been so much talk on Wall Street about the subprime mortgage segment. A lot of companies that are involved in lending subprime mortgages have really been hit hard on Wall Street. It's taken the market down as a whole in a couple of days. How is this impacting our local real estate market?
Well, we have to look at the net effect of the subprime lenders. Now, as we've always discussed, Manhattan itself has remained somewhat insulated, although not immune from the rest of the market. But the subprime lenders, if you look in 2000, about 2% of loans originated from subprime lenders. In 2006, we saw about 40% of those originate from subprime lenders. Now, what subprime lenders predominantly worked with are the interest-only loans, buyers looking with lower credit, and people taking some of the more exotic loans that have been out there that we've discussed. The most important issue here is that it's going to cause a net effect of the banks, the lenders, being a little bit more cautious about who and how much they're lending. So, in a sense, it will temper spending a little bit out there. Again, this has also led into the story that we've heard about foreclosures and the similar scenario. The important fact here is that, as we discussed in the past, you have to look at the type of loan you take out with a mortgage, be it a 30-year fixed, an adjustable rate, which gives you some flexibility of a lower rate with a variable term, than the interest only, which is not a bad tool to use, but you truly have to be careful about the time frames that you're using for those loans, whether you're going to stay in that property, because after the interest-only portion, your loan becomes a considerably higher number because it's amortized on the years of the non-adjustable section.
Well, so you have to be careful. Darius, very good morning. We appreciate it very much.
Always a pleasure.
Great to have you with us.
Thank you very much.
Good information.
Thank you.
Yeah. Okay.
Darius knows what he's talking about.
Yes, he does. He's the man. Coming up next, the latest on the winter weather.